So I think the biggest mistake and the biggest lie that prop firm traders have been told is treating their prop firm challenges like game day. Let's say you're a football player and you've spent your whole amateur career training, doing extra cardio, you're prepping, you're watching your diet, you're training, and then when it comes to the big game day of the season, that's when it's time to show off everything you've been preparing. And that's the mistake traders make when it comes to trading in the prop firm challenge. They think that all of the preparation that they've done, all of the mentorships, all of the hard grueling nights and days back testing and finding a strategy, finding consistency, they think, okay, now it's time to shine. They bring all of that into their prop firm challenge. You're putting way too much pressure on yourself, you're putting way too much emotionality on yourself, and that's exactly what the prop firms want. They want you to feel all of this pressure and emotion so that you crumble under the pressure. It's very easy for someone to come and tell you, find your track record, build consistency, trade for 1 year, prove to yourself you are a profitable trader, and then take the live accounts. Again, that is wonderful advice, and that's what I would tell all of you to do. Something I did myself. I traded a demo account for my first 1.5 years before I even traded a live account. Not because I was particularly intelligent or smart or because I have the best mentor. It was more so that I was a student at university. I didn't have money to throw into brokers or throw into challenge accounts. But now 5 years later, this is where the magic happens. I've spent a lot of time working with a lot of people. I've spent a lot of time in my own trading, and I've really immersed myself, and I've come up with 2 key ways that will really help you reform the way you look at prop firm challenges and completely change the way you approach them. Because my belief is the way you've been taught to trade and everything that you've seen online in courses and YouTube videos is completely true. You should follow risk management. You should follow a good trading plan. You should trade without emotions of feed, greer, or FOMO. This is great advice. But you apply all of this to a live funded account or a live account in a broker. But I don't think you apply this kind of knowledge to a challenge, because the trap that prop firms make you believe is that the challenge is a simulated environment. The challenge is a test for you. But when in reality, all of the rules that they put in place, they're not in your favor and they don't even make sense to me. Why do you need to get 10% in 30 days? Why does that even make sense? Why do you need a minimum of 10 trading days if you can pass that account in 3 days, for example? There's all these rules put in place, and the only reason that they are put in place is the business side of prop firms, because it wouldn't be a functioning business if everybody was profitable, despite what they say on their websites of when we win, you win. That's a lie. So what are we going to do to combat that? Because when it comes to a normal trading condition, we can take our time, we can trade with the risk management we want. We don't have a rush of meeting a certain target. We don't have drawdown limits and all these things. That's when we are in control of our trading, and that's when we are in control of our mind. But when we enter a prop firm challenge, it's not our home turf. That's an away game. So I'm going to give you 2 main points in this video that I want you to go ahead and think about and test, because I have found that has helped dramatically increase the success rate of people going to pass a prop firm challenge. So the 2 points that I want to cover is, number 1 is the golden bullet strategy. Now it sounds a bit outlandish, what could be the golden bullet strategy, but I'll cover that. I think it's a very cool approach. And the second one is what I like to call the staggered approach, where you have rolling funded accounts, and then overall that will lead to a portfolio as opposed to too much pressure on one account. So before we get into the bulk of what are these strategies, there's 2 things I really want to establish, which is you have to be aware of your win rate, and you have to have objective methods in place to take profit off the table in terms of where you take partials and what your risk reward profile will look like. So I'm on my iPad right now, and I think it's important to recognize, obviously follow risk management. When it comes to myself, what I do in my own trading is usually, actually I'm very conservative. My risk is usually 0.25% per trade, maximum 0.5%. I'll rarely go into a 1% or 2%, but my profitability doesn't come from my risk. My profitability doesn't come from my win rate. Actually, it's quite a low win rate. It's about 45%, sometimes 50-55%. The reason I'm decently profitable is because I play the risk to reward game. Now the problem or the trap people fall into is thinking risk to reward means the bigger the better, or size matters. I don't know. They think that, if I get a 1 to 100, I'm a better trader. Not necessarily the case. What you need to really realize is you need to remove an element of sporadicness. You need to remove an element of subjectivity, and you need to remove the element of emotion, especially when it comes to taking profit. Now, why is that important, especially when it comes to taking profit? Is because when we are entering a long position and we are entering drawdown, usually we think, should we move our stop loss a little bit lower? Should we adjust a little bit? Should we give a little bit breathing room? We start going into the M1 and justifying, oh yes, it's reversing here. You start inventing concepts. You start inventing ideas to say you're right. So what does that mean? When you are entering your drawdown, when you're hitting your stop loss, we're always a little bit hopeful, like, oh, it's not going to hit. It's going to reverse any second now. And we try and hope and think it's going to be fine. But what happens when we are reaching our TP? We don't do the same. When we're reaching our TP and it's just floating around, it's just 5 pips shy of our TP, usually people get fearful, like, oh, but what if it reverses here? What if it's not going to reach? And you get into this fearful thing and usually just close it out. But you don't close out a loss, but you'll close out a win early. It's just human nature. So we have to realize we cannot be reliant on subjectivity when it comes to taking profit, because we're always going to be in that fearful mindset of, should I just close it out early? Second of all, you can always have varying opinions on when to take profit. You can have profit based on structural points, and that structure could be an M15 lower low, or it could be a H1 lower low, or it could be a swing lower low, or it could be an intra-session new low. It could also be taking profit from the liquidity pools. It could be, let's say, Asia low, or it could be a trendline liquidity, or it could be previous days low, or it could be previous weeks low. So when you have all of these areas that are valid, when it comes to the real life market conditions, you'll confuse yourself into thinking, today I'm going to take Asia low, the next day I'm going to take a new swing low, the next day I'm going to take an intra-session low, and you're going to be doing all of this randomly depending on what? Depending on how you feel, depending on how fearful you are, but also depending on where your challenge is at. So for example, at the beginning of your challenge, you might be just very like, I've got 30 days, I'm good. And what do? You just hold out. You've got plenty of time, I've got plenty of opportunities. So you let those trades really, really run, and maybe you don't take profit early enough. But when it gets to the end of the challenges, maybe in the last 3 days, you're in a panic state, like, oh, I got to secure everything. And you maybe just take small profits at 1-to-1 risk to reward, but those trades might have played out to 1-to-6 if only you had waited. So we don't want to enter this spiral of chaos where sometimes we're taking partials differently depending on the market, or also depending on the emotions we have or the situation on our prop firm account. So all of this is not smart. This is not systematized. This is not what a professional trader would do. A professional trader is going to be stoic. Professional trader is prepared. Professional trader has a plan. So when it comes to taking profit, there should be no emotions attached to it. It should be completely objective, mechanical, and predetermined. Now, there's 2 ways to do this that I believe. Number 1 is your fixed protocol. The other one is your price action protocol. There's 2 ways to optimize your trading system. One way to optimize your trading system is to optimize it for each trade. So you want to squeeze the most out of each trade and maximize each winning trade. That's one way. The other way is maybe you don't care about each single trade, and maybe on a Monday you don't maximize it as much, and maybe on the Thursday you do pretty well, but you're not too concerned with the daily fluctuations. Rather, you are more concerned with the overall portfolio efficiency and maximizing your portfolio. So there's 2 ways to look at it. Do you want to maximize each individual trade, or do you want to overall maximize your portfolio? There's no right or wrong answer. I lean towards personally maximizing my portfolio. Now, what that means is when you take a price action based protocol, that means some days you're going to be taking profit based on a swing trade. Some days you're going to be taking profit on an Asia low. Just all dependent on the day. It's dependent on what price action is showing you, and that is subjective. That means each trade is going to be different, because if you know you're taking a pro trend with swing potential, you're only going to start taking partials after the H1, H4 daily targets. But if you know you're taking a counter trend hedge trade based on an intra-session New York trap, maybe your target is only 15-20 pips. So therefore, you're going to take profit way more aggressively because you're not expecting the trend to change. It's a counter trend trade, so you know it's short-lived anyway. So you're going to be reacting and deciding differently depending on the market condition. Whereas the fixed protocol is no matter what, it doesn't matter if it has swing potential and is pro trend, doesn't matter if it's counter trend and is just a hedge, you have fixed targets to take profits. Now that might sound kind of counterintuitive, but that's what I like to do. Number 1, because it removes all emotion, removes all decision making, removes all subjectivity, and removes all of the cognitive biases we may have. We just have a fixed system. No matter what's going on, it's fixed. So the way I apply it is when I enter a trade, let's say I'm using 1% risk. Now 1% risk, I'll divide it into 2 positions, and that 2 positions will be at a 1-to-3 risk to reward equals 50% of the volume, and then at a 1-to-10 risk to reward equals my remaining 50% of volume. So overall, when I do take the fixed protocol method, I'm going to have my 1% risk, so 0.5% of that risk will go to a 1-to-3 equals 1.5 R/percentage. And then the second position is going to be 0.5% also. That's going to go to a 1-to-10 risk to reward position. That's going to equal 5 R/percent, because I'm assuming 1% risk. So my total, even though the total target was a 1-to-10 achieved, because I took partial at a 1-to-3, my total ROI will be 6.5 R/percentage. This is obviously not optimal in certain cases. For example, let's say you have a swing position that could have been a 1-to-30, that if you held for a few weeks could have been a 1-to-100. It happens all the time. That trade will be severely short-lived because you only capped it out at 1-to-10 and you only took 6.5 R. But if you took the price action protocol route and you allowed it to take the swing targets, maybe you could have taken out of that theoretical 1-to-100 risk reward in terms of the setup, maybe you could have taken 30% return on that 1-to-100 trade based on how you took partials. But if you took the fixed protocol route, you only took a 6.5% as opposed to a 30%. That delta is a huge inefficiency, of course. And that's not what you have to focus on. That's the trap, actually. So what I would rather focus on is, what about all of the times that I was hoping for a 1-to-10 or a 1-to-20, but it went to 1-to-3 and break even, which when I analyze my portfolio, my win rate is around 40 to 50%, which is fine. But when I factor in my break evens and I'm able to secure secure profit on them a little bit, my profitability increased significantly in terms of what I was able to capture, because I could have a wrong trade. I could have a losing trade even, where price could have reversed and maybe even hit my stop loss, or my idea was just completely incorrect. But because I have usually a tight stop loss of 3 to 7 pips, for me to catch a 1 to 3, that can just be from Asia low to Asia high. And maybe then price reverses on me and doesn't do what I was hoping it would do or thinking it would do. But even though I was wrong in my trade idea, I was still able to secure the 1 to 3 and therefore 50% of my volume at 1.5R. So over the space of the week, let's say I took 20 trades, which does happen quite often. Out of those 20 trades, maybe 10 of those trades I was just incorrect. I didn't have the correct directional bias. I didn't have the correct read. But out of those 10 trades, instead of letting them go to a loss or a break even and completely wasted, I was able to secure out of those 10 trades, maybe 5 or 6 of them, secure a 1 to 3. So therefore, these small wins of 1.5R, 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 just by being wrong throughout the week, and those losses that were previously just not going to my favor, at the end of the week, I could be 5, 7, 10% up without being correct, just by smartly taking profits, just being by intelligent in terms of my profit taking system. So in the price action protocol system, where I'm hoping for my swing targets, that requires me to be correct. And therefore, I have to have a slightly better edge or slightly better understanding of the market. But when you take a fixed protocol system, it allows you to be incorrect and still make profits. And these small wins really compound and really add it up. So when it comes to the price action protocol approach, what you do is you have your 1% trade and you'd have it just as one position. And then what I'll do is, depending on the day, let's say I know the overall target is a 1 to 40 risk to reward target. So I'll break it down into, let's say, main push, liquidity pool, swing. So I might divide it into these 3 things. So I might take 30% of my volume at, let's say, Asia low, 30% of my volume in making the next lower low, the next main push, and that would be 60% of your volume. And then the swing target, maybe it makes a daily lower, long-term swing target, let's say 30%. So when it does reach your final target, yes, you have a 1 to 40 risk reward in terms of the potential of the setup if you held full volume. But because you are still taking partials along the way, you are delaying them and you're doing it smartly to maximize the swing position. But it has that caveat of, if it goes to your final target, then this division is optimized. But what happens if it only goes to your liquidity pool and main push, but not your swing target? Then you have a bit of inefficiency and you left a lot of money on the table. And that a lot of money on the table could be 10%. So it's actually quite a large inefficiency, because you're leaving 30% of your volume on the way to a 1 to 40. Let's say it reverses at a 1 to 30. So 30% of a 1 to 30 is 10%. It's quite a significant amount of volume you leave on the table. So I thought that's quite an inefficiency. And with the fixed protocol system, I was able to catch small wins, which paid for my next loss, which kept my account growing. And that's the vessel I chose. And I think that's something you should also look into and consider. So now I'm on TradingView and I'm going to show you some example of how to use the fixed protocol system and how you can apply it to a silver bullet strategy. And it's quite important. So first we establish that, then we'll get into the strategy itself. So here's just a random trade that I took. And first of all, just a quick breakdown. We had the supply zone. It's a decisional that led to a new low. Therefore, we know it's an interesting POI. Price then does a complex pullback where we have the internal push to establish the internal trend, internal high. This area fails to make a low, therefore it's an internal higher low. Complex pullback established, counter trend, you're going to have that efficiency up all the way where to our decisional or extreme. Price comes to that decisional area during a New York session. What does it do? It does a trend line liquidity over here, makes a decisional and pushes low. What does it leave? It leaves this liquidity target for the next day. So once we have that liquidity target for the next day, what does price do when it arrives to the area? Let's jump down a lower time frame. So we're getting a reaction off the supply zone. And once price has reacted off that supply zone, it gives an internal reaction. So this is where we peg our daily cycle into it. So price has reacted off the supply zone. The major supply zone is the decisional area. This is a nice area you want to be seeing a reaction from. How does it react? It gives this trend line liquidity. Now what does it do? It gives you a build up, it gives a trap, it gives a smart money trap. Then what does it do? It taps into the extreme. We know this is a nice area because it did a minor inducement. So it does a mitigation of that minor inducement. We know we had that small run of liquidity there. So we had a build up over here, inducement into the POI, trend line liquidity target, price is magnetized towards that area, remitigation, banker block, and then shoots low, takes all of this liquidity, and now we have made this base. Price is magnetized towards that low now. So now we've established that. What is price doing? It's building up liquidity over here. It's made a smart money trap. Why? Because it's given equal lows to smart money traders. It's told them this is your FU candle over here. And how has it done it? Even within the FU candle of smart money traders, is giving you more equal lows. So this looks like a nice smart money zone, pushes out, and then it gives a bullish BOS over here. Price is giving that internal bullish BOS. So now what are smart money traders thinking? Smart money traders are now trapped into thinking we had this liquidity, price ran that liquidity, FU made a higher high, price came back to this extreme area, gave a equal lows, gave an FU candle, mitigated this area, and then gave a push out to give an internal BOS. Everybody's going to be buying in this area. And what does it do again? It gives equal lows, shows you the buying sign, and then takes them out, wiped out. So that's how this, this whole daily cycle variations going on over here. But what I'm really interested in is reading. Price has now come, gave that minor inducement, printed a trap, done the mitigation, taken them out, printed a new trap. Okay, making lows up on that IFC area. Then it gives another smart money trap with equal lows, FU candle, push up. And what is it doing? The correct narrative is it's taken Asia high liquidity, it's mitigated this area, perfect. And then what has it done? It has given a smart money trap inducement, but it's also given the internal BOS. So if now I jump into M1, we can really read into that. So this is where the magic is really happening. As price came back up during London session, it came into this M5 zone. And what did it do? It did a perfect mitigation. So let's put that as a supply zone. Okay, price came into that supply zone. And what did it do? After taking out smart money traders with the smart money trap here, equal lows, FU candle, push up, inducement down, and inducing that smart money trap. So we had two smart money traps running in conjunction. We had two smart money traps, and therefore that was the inducement. And then price came into that supply zone that led to that inducement. It's a real push. It's a real move in the market, institutionally funded. Therefore, an IFC is developed over here. And then what do we see within the IFC? We see M1 price action where we have this internal high low that made an internal high, induced this area to the left. Okay, so perfect in inducement there. And then it gives an internal BOS here. Okay, perfect trade, perfect setup. And what can we see? We have higher high, higher high with an inducement, lower low, and then we just target that candle refined IFC area over here, and that became our entry. So the entry was about 4 pip stop loss, targeting right here. Now we have a trade example. Now we can apply our protocol systems and how we take partials. So the normal way would be next target is going to be, let's say, at swing push, because we know this is pro trend coming off a supply zone. What we are going to be looking at is that if we knew all of this was a complex pullback into that supply area, therefore we know that this is the retracement, and therefore a new main push should happen. Just like following this main push to make the lower low, we know that we can replicate that and make a new lower low as such. So therefore, we know that this is our main target to make a new low. So now we know that we are going to be holding out to at least making a new lower low. And therefore, sensible places to take partials would be at this liquidity pool and new swing lower low. And that's how you'd probably be managing it. Now, that's fine in certain trade conditions, but that is a subjective approach based on the price action. So that's using your price action protocol. But if we use the fixed protocol system, which in certain trades, it's inefficient. In certain trades, it's you are compounding it, but you're looking at your portfolio overall, where you might maximize some trades, you might not maximize and have inefficiencies in other trades, but you also get the benefit of that compounding win when you are even incorrect. And therefore, you are not trade by trade efficient, but your overall portfolio is maximized in a nice way, because the ones that were inefficient are paid for by the ones that were efficient and the ones that were incorrect. So that's how we are balancing the portfolio overall, as opposed to a trade by trade basis. So when it comes to our fixed partial protocol system, what I'm going to be doing is our 1 to 3 risk reward, I'm taking a partial no matter what. So my 1 to 3 is going to be here. So I put a line here, 50% volume. That's what I'm doing here. And then at my 1 to 10, I'm going to be taking my next one right here. This is our 1 to 10, 50% volume. So overall, this trade, it did reach both targets, but it didn't reach any of our main targets. It didn't make a lower low. It didn't need to. Okay, so our trade was short-lived. Okay, we got the first target, which was the liquidity pool of completing that intra-session main push. But this winning trade led to the 1 to 3 at 50% volume, meaning 1.5 R, and then the 1 to 10 final target, another 5 R. So combined, we had 6.5 R for a full win. Let's say this trade was only making the new low over here, made a new lower low, and then reversed. In that case, we would have taken at least the 1 to 3 at 50%. So we would have locked in a 1.5 R. But if we were using the other strategy of waiting for the lower low and so forth, we maybe would have taken no profit. So this is why it's important. And again, when you test this out over winning trades, losing trades, break-even trades across a month, you'll see the efficiency that it does bring up. Now that we've understood a trading example, now I'm going to come onto my Excel spreadsheet. And this is where we are going to be revealing the golden bullet strategy and why I think it's pretty useful, not for your live trading. I would never, ever use it in my live trading, But when it comes to a funded challenge, this is the way to do it, I believe. But there's a few criteria that need to be in place. So over here on the screen, you can see my Excel spreadsheet. And this is how I kind of track how I can pass a challenge, because it's going to be telling me the risk that I need to put in and some factors that I need to be aware of. But before we cover this, it is important to realize this way will guarantee a pass on a few conditions. If you have at least a 50% win rate and at least you can get a 1 to 10 risk reward. If you can do these two things and you follow this plan and you have a minimum of 50% win rate, you will be able to pass the challenge for sure. But the problem becomes is if you don't follow it properly, if you over risk and over leverage, if you don't have a 50% win rate, or you are just going through a losing streak because you lost composure because you took trades that you're not supposed to take, then this is going to blow your account very quickly. So you do have to be careful. But this is optimized not to be a good trader. This system is optimized to be able to pass the challenge effectively, because the prop firms are putting traps on us. They're putting hardship on us. This system is how to counteract all of that. So what I've coded is basically, I know with the partial protocol system, a loss is minus 1R. A total win is plus 6.5R. And a partial win, when I get that 1 to 3 risk reward and I take 50% volume, that equals a 1.5R. These are my dynamics I can play with. That's the only thing that can happen. I lose, I partially win, I totally win, or I take a break-even trade. These are my 4 variables. So I coded that in. So once I had all of these, I thought, instead of relying on 2 or 3 wins, so let's say I end up in 5% drawdown and then I have 1 win which gets me back to neutral, and then the next win gets me to 6.5% up, and then the next win crosses me into passing the challenge. I was like, what if I could just do all of that in one trade without blowing the factors of the trading account? I would never put 3% on a trade. I would never put 5% on a trade, but it's a prop firm challenge. It's not a real account. It's not real money. Obviously, people have this pride in saying, you know what, I want to be a proper trader. I want to do everything correctly. I don't want to go into even 1% of drawdown. I'm going to use strict risk management, which is exactly what you should be doing on a live funded account. But on the challenge, who cares? It's not real money. And if you really mess up, if you really screw up, just buy another challenge. It's not the end of the world. But play within their boundaries, play within their rule sets. This is what it looks like. So over here, we have the number of trades, so we can track what trade we are on. And then we have our account size to start with. And that's going to be obviously the 200K account. Then it's telling you the starting risk. So it does tell you what risk to put in, and you just follow this. It's a risk management tool. And then it also tells you your risk in dollars, just so you're aware. So if you use a lot size calculator, you can put in, I want to lose this much amount, and you have to be careful to factor in commission and spread, of course. And then you just track the outcome of the trade, and then it's going to tell you your floating balance, it's going to tell you your P&L, and it's going to tell you how far away you are from your target, which is, in this case, I put an 8% target, because now the new norm is 8% target on a lot of these challenges, with the 6.5% multiplier or 6.5R multiplier for a full win, and a partial win being a 1 to 3, so a 1.5R. So once we factor that in, first trade is telling me put 1.23% risk. Therefore, I'm going to be risking $2,462 on a 200K account. Now, let's say that trade is a break even. So what happens? I risk 2.4K. Floating PLL, no change, therefore my account balance is exactly the same. I stay on 200K and my distance to my target is the same. Now, let's say I take another trade. That other trade is now a loss. Okay, now I'm minus 2.4K because it told me to stick to that risk, and now I'm on 197K. Now my distance to my target has increased. Now I need to make the 16K target plus recovering my loss, so my overall profit required now is 18K. Now my next trade, let's say my next trade is a break even. Nothing happens, I'm still on 197K. Now let's say my next trade is a loss. Okay, now I'm getting even more and more loss. Let's say my next trade is a loss. So I'm having a terrible performance. So it's telling me my account balance is 191K. Remember, the lowest I can go is 180. Now it's telling me I should risk 1.98%. So therefore increase my risk from the beginning of 2.4K to now increasing it to 3.7K. And therefore my target now, I have to get 24K. So it's really, we're looking not good. So let's say my next trade is now another loss. And let's say my next trade is, let's say, a break-even trade. And let's say now I finally get some luck and I get a partial win. So now how things are looking. So it's telling me, as I was getting more and more into drawdown, it was increasing my risk. It was telling me how to manage my risk. It was tracking my account balance. And therefore, this last break-even trade, it was telling me you need to risk 4.3K and therefore 2.3% of the account. And when I got that partial win with 4K, remember it's a 1 to 3 risk reward, taking 50% is 1.5R. So that partial win banked me 6.5K. Okay, so that 6.5K that it banked me was pretty useful, because now I have recovered a bit of my account from going from 187K to 194. I'm still not in the green. But let's say I take a few more losses. I take another loss. I take another loss. Terrible win rate. I don't even know what it is. But let's say I'm now getting pretty close to blowing the account. My maximum I can blow is 180K and I'm 186K. And let's say now finally I get a win. A full win out of 1 to 10. target. Therefore, at 1 to 3 risk reward, I take 50%. At 1 to 10, I take 50%. Total is 6.5R. But in this trade, what is it telling me to risk? It's telling me to risk 2.39%, therefore 4.4K. And let's say that trade finally pays off. It's finally a win. Now what does it do? At 2.3% risk, which is within the boundaries of all of these prop firm challenges. The maximum drawdown I can have 10%. This is about 8%. The maximum drawdown per day is 5%. So this was only 2.3% for that day. And then that trade played out to be a win. Therefore, risking 4.4K, I got with a 6.5R multiple, I got 29K. So it recovered all of my losses. Look how many losses. 1 loss, 2 loss, 3 loss, 4 loss, 5 loss, 6 loss, and a bunch of break evens. My win rate was like 10% or something. Even with a terrible win rate, once I did get finally that win, which is inevitable, if you play it correctly, you can have a bunch of losses. Eventually, when you do get that win with a scaling risk that is intelligently planned, when you do get that golden bullet, when you finally get that winning trade, it not only brings you back to break even, it brings you all the way to your final profit target, and it just takes one trade to win and pass the challenge completely. So if we look at it, finally when we got that 1 to 10 trade, which again, I've shown you a bunch of examples from time and time again, this is an ordinary type of trade to take. It's not a needle in a haystack, Hail Mary, perfect trade. This trade can happen very, very often. So if you do finally get that trade, which could be at any point during the week, you just have to manage your losses, manage your drawdown, and eventually when you do get that win, you have your 6.5R, you risk 4K, which is within the risk boundaries of the 2.39%, and then your return became 29K, and therefore your profit to your final target, which previously was 29K. In one trade, you won 29K. So you recovered everything and reached your target. That is the golden bullet strategy. I also have another spreadsheet that I've developed, which is the silver bullet strategy. It's not quite golden, but it's 2 shots. It's 2 shots to get to there. So instead of you relying on one big win, you rely on 2 wins. And it just means you're not as aggressively risking in each trade. So that means you can have slightly more losses. So this one only requires you to have a 50% win rate. Even a little bit less is fine because it just takes one trade. You could have losing trades all the way to minus 10% and then one trade to win it. So you can have a 10% win rate. But when you have the silver bullet strategy, it allows you a little bit more breathing room and it's a little bit easier to manage because it's smaller risk per trades. But either way, both work. I've tried it. I've tested it. A lot of my friends have tried it. A lot of our members have tried it. So what I'm going to do is if you leave your email in the description, I'll get this over to you so you can at least start to plan with it in terms of your back testing, test it out. And then eventually, if you do find validity in it, if you do think it'll be useful, then you can try it out in your own challenges. But again, this is only for your challenge accounts. It's not for live accounts. It's not for live funded accounts. This is just to be in a simulated environment and maximize within the parameters of the rules. And that's why I coded this such thing. So yeah, do let me know in the comments if you think this was useful, if you think this is something you could use, and if it's an idea you even thought of. And by the way, if you watch my previous video, I talk about how to manage prop firm accounts even better in terms of strategies you should have in place. And that video, I go quite in depth into that. So that's a video I do think you should check out. So I'll see you over there.